Polymarket, Kalshi, Robinhood, and Coinbase are the four most talked about and utilized prediction markets on the planet. This is a deep dive into how they work, how probabilities move, and why reading the rules matters more than headlines. Welcome to Mark's Financial Playbook. Today's not your typical Roth conversion or tax strategy video. Not a day goes by that I don't hear the word Polymarket or prediction market odds on this or that, or which platform is the best. So over the past 90 days, I did a deep dive into how these platforms work, how to build strategies, how one prop caused two platforms to pay opposite results, how celebrity markets trick traders into emotional decisions, and how to trade live games 3 different times. This is all about understanding probability, not guessing outcomes. Or is it flat out gambling? Let's take a look at this clip of Coinbase's CEO, Brian Armstrong.
We've been having discussions about Polymarket and prediction markets and everybody betting on what people are going to say at any given moment. And you read off the words that people were betting on the call. You said Bitcoin, Ethereum, blockchain, staking, Web3. Tens of thousands of dollars had been bet on each of those words. People were betting on whether you would actually say those words, and then you effectively were trolling them, I think. Can you tell us, tell me what you think about that and what you think about prediction markets if you can effectively determine the winner in such a way? And by the way, there's lots of folks who are now there are people in here. I heard that there were people making bets about what was going to happen at DealBook. CNN just made a contract with Kalshi, apparently, to have people bet on news. Mm-hmm. What were you thinking during the conference call?
Yeah, well, the conference call was me just having a little bit of fun. But I think the bigger picture here is that prediction markets are a big deal. And it's for 1% of people, they're trading it just like another asset class. But for 99% of people, they're looking at it as an alternative, I think, to traditional media, actually, to figure out what's going to happen in the world. And then some people are also just using it for entertainment.
Do you worry about manipulation? I mean, that's the other big part of it. And by the way, you effectively manipulated the outcome.
Yeah, well, I didn't trade on it, of course. But I actually had a really interesting conversation with one of the folks that was nominated to be CFTC commissioner about this. And he asked me, he said, do you think we should allow insider trading in prediction markets? And I said, it's actually it's not as clear-cut question, right? Because if your goal is to actually, for the 99% of people trying to get signal about what's going to happen in the world, like is the Suez Canal going to be reopened or whatever, you actually want insider trading. You want, some admiral sitting on a ship in the Suez Canal who has really good information to be trading so you get better, higher quality signal out of them, right? Now, if you want to preserve the integrity of those markets, maybe you don't want insider trading, right? So there might be like a decentralization test that has to go in here, but it's not a clear-cut answer.
I'm having a hard time understanding how people in the know don't have an edge, or is this by design? A Mr. Beast editor found himself on the right side of a play, but on the wrong side of the outcome. What a prediction market actually is. A prediction market contract pays based on resolution criteria, not on opinion, not logic, not social media confidence. If the written rule conditions are met, it pays $1 per contract. If not, it pays 0. Price equals probability, and you could trade in and out before resolution. Let's say the odds of an outcome, whatever the event, are 90% yes. This shows the outcome is the likely outcome or the favored outcome. Therefore, at 90%, if you bought $100 worth and you were correct, you would profit only $10 because this was the likely outcome. On the other hand, let's say you took the other side and you said no to that outcome and you were right, that same $100 would get you $900 in profit. Pretty good. And the odds fluctuate in real time through the duration of the event. In some cases, the event is daily, like the Super Bowl or the big game. Or maybe it's a time frame, like the end of 2026. Interest rates will have risen 2 times, 3 times, or no times, and each one of those has its different odds. Now let's walk through a real example. Anthropic takes aim at OpenAI's ChatGPT and Super Bowl ad. Media coverage framed this as an Anthropic Super Bowl ad, and that framing influenced how traders interpret the contracts. What actually aired? The commercial showed Claude, which is a product made by Anthropic. Important detail. The company name, Anthropic, was not clearly shown in the ad itself. That single detail created different outcomes across all platforms, including Coinbase, and we'll get to that later. Core distinction, company versus product. Anthropic is the company, Claude is the product. Some markets treat a flagship product appearance as the company appearing. Other markets require the company itself to be explicitly identified. Let's look at the Kalshi wording. Kalshi style wording says, the word runs implies the official advertiser, not just a product shown on screen. If the company itself is not clearly the advertiser, the contract can resolve to no. The Polymarket interpretation. Polymarket style interpretation is often broader. Phrases like have an ad or appear in a commercial can include product branding. So if Claude appears, traders may interpret that as Anthropic having an ad. Why results differed? Same real world ad, different rule interpretation. One market treated product equals company and paid yes. The other required the company itself to be advertised and paid no. And to further this point, Coinbase was flooded with complaints about the wording and resolve of their Anthropic contract. They are offering refunds. Here's another prop that took place during the big game, the Super Bowl, that actually didn't pay out until 5 days later due to the mass confusion and utter disbelief of the outcome. This is a great example of how probabilities move in real time. At one point, a contract traded above 60%. Momentum buyers entered. Narrative was super strong at that time. This is the big game attendance markets. The contract was on which celebrity will attend the big game. You'll see names like Taylor Swift, Elon Musk, Donald Trump, celebrity quarterbacks, big name athletes, and even CEOs. And on this particular contract, one of the most popular A-list actors on the planet. And with all that, markets move fast based on rumors. This is where trader psychology gets a little wild. Some people say, he's definitely going. Others say, there's no way he misses this game. Odds spiked heavy on Friday when he was seen by TMZ outside Fanatics in the Bay Area, which is only 20 minutes from Levi's Stadium where the big game is being played. At that point, people had already concluded there's no way on earth that a lifelong Pats fan would be in the Bay Area, seen talking to the Pats owner, caught on TMZ, and not go to the game only 2 days away. Info started coming out that he was seen in LA, he was in Vegas golfing. Some even said his private jet was still in Vegas' airport 10 minutes before kickoff. Odds were dropping fast at that point. Some people thought it was just noise and were already celebrating a win. Others were caught off guard and didn't know what to do. Keep their play, cancel their play, switch their play. Odds were moving back and forth from 77% all the way down to 5%, back up to 60%. It was a frenzy. But remember, prediction markets don't resolve based on vibes or rumors. They resolve based upon proof. Rules versus assumptions. Attendance contracts usually require verification, visual confirmation, official broadcast appearance, or approved news source confirmation. Not rumors, not social media guesses, not insider claims. Lady Gaga was there. Cardi B was there. Tom Brady got himself a yes, he was there. But Mr. Wahlberg was not among the celebrities featured at halftime as the camera panned the stadium. At that point, having not been seen at halftime, not seen at the game, panic was in full force. People were still certain at that point he was there. In the end, he was not there. Fun fact, $23.7 million were traded on whether he would attend, far exceeding other celebrity, athlete, or other political figures. Most beginners think you must hold until the end of the prop. Not true. If you buy at 30% and price moves to 55%, you can sell and exit. Profit comes from probability movement, not just final outcome. Polymarket, Kalshi, Robinhood, and Coinbase may show similar questions, but often resolve differently. Never assume rule parity across platforms. Open the rules tab. Believe me, it'll help. Read it fully, every word, then trade. Before entering any prediction contract, read resolution rules first. Check proof requirements. How's it going to pay? Check the time window. When's it expire? Check accepted sources and expect rumor volatility, and assume you'll likely be wrong. Or you could be right. You don't know. Probability is price, not truth. Here's a live game feature demo. Denver versus Buffalo. Now let's shift from celebrity attendance to something I personally think is the most powerful feature on prediction markets. Live trading during the event itself. This next example shows exactly how you can trade a single event multiple times. No pregame entry, no guessing early, just reacting to live probability changes. So let's look at this one. Start of the game. At this point, no position, because waiting is a strategy. And with 22 seconds left in the second quarter, Denver scores a touchdown. Buffalo becomes a live underdog. So the first play is Buffalo plus 3.5 points. 1,018 contracts entered live. This is buying the overreaction. Then Denver kicks a last-second field goal. Halftime score, Denver 20, Buffalo 10. Denver scores again in the third quarter. Now it's 23-10. Buffalo becomes an even bigger underdog. Second play, Buffalo plus 6.5. So now you have Buffalo plus 3.5, Buffalo plus 6.5. 925 contracts. Same team, better number. Then momentum reverses. Buffalo comes down and scores 23-17. Early fourth quarter, another touchdown. Buffalo actually takes the lead. Now the market flips again. Late fourth quarter, Buffalo leads 27-23. Denver becomes the underdog. Here's the third play. Denver plus 2.5. 769 contracts. So in one single contest, you have Buffalo plus 3.5, Buffalo plus 6.5, and Denver plus 2.5. 3 separate entries, 3 different moments, all based on probability movement during the game. Final score, Denver 33, Buffalo 30. All 3 positions win. That's not luck. That's understanding how live probability markets move. Prediction markets are not just pre-game bets. They are real-time probability exchanges. You can wait, watch volatility, and enter when the numbers improve. In closing, prediction markets are growing fast. They are powerful tools, but they are rule-driven instruments. The edge is really not guessing right. The edge is understanding how contracts resolve. Read the rules, respect volatility, trade probabilities, not emotions. This is Mark's Financial Playbook. Subscribe to the channel. It's completely free, and I will see you in the next one.